Welcome to The Explainer. Today, we're diving into something huge, a blueprint for creating real, long-term wealth in the Indian stock market. Seriously, we're talking about how you can navigate what might be one of the biggest economic expansions we'll see in our lifetimes.
All right, let's just start with one number, a really big one, $16 trillion. That's the projected size of India's economy in about 17 years. I mean, just let that sink in. It's an absolutely staggering figure, and it signals a historic shift in where global wealth is being created.
So look, this is way bigger than just picking a few stocks, right? This is about getting your head around the sheer scale of the economic transformation happening right now. This is the big picture, the massive tailwind that could, honestly, lift an entire generation of investors.
And check this out. This data comes from a really deep study by Motilal Oswal, and it shows this incredible pattern. It took India all the way until 2008 to hit its first trillion-dollar GDP. Now, in the 17 years since then, it's on track to quadruple to $4 trillion. But here's the crazy part. The projection is that it could quadruple again in the next 17 years. We're not talking about a straight line here. This is pure exponential growth.
Okay, so with that kind of insane economic boom on the horizon, the billion-dollar question, or maybe the trillion-dollar question is, how do you find the companies that are actually going to ride this wave? The ones that will create truly extraordinary wealth? Well, the answer lies in hunting for a very special kind of business. What you're looking for are what the experts call compounders. And listen, these are not just your average good companies. No. These are the elite of the elite. Businesses that just consistently grow their value year in and year out, and they turn what would be solid returns into absolutely spectacular ones over the long haul.
But here's the catch. Finding them is really hard. I mean, incredibly difficult. A landmark study actually tracked 500 of India's top companies starting back in 2008. And over the next 17 years, guess how many became true long-term wealth compounders? Just 35. That's only 7%. These things are like diamonds in the rough. They are incredibly rare.
So you're probably thinking, okay, if they're so rare, how on earth do you even start looking? Well, thankfully, you don't have to go in blind. There's a proven framework, a system that can help us stack the odds in our favor and actually spot these rare opportunities.
All right, let's get into it. It's called the QGLP framework, and you can think of it as your blueprint for finding these compounders. It basically breaks down this really complex search into 4 simple, logical parts.
First up, you've got Q for quality. And this is more than just, do they have a good product? It's about the whole package. Does the business have fantastic leadership, a powerful brand, and, what Warren Buffett famously calls a moat, some kind of durable competitive advantage that keeps competitors at bay?
Next, we have G for growth. Pretty straightforward, right? But the key here is that you're looking for businesses that have a clear path to sustainably increase their profits. Not just a one-hit wonder, but consistent, reliable growth year after year.
Then comes L for longevity. And honestly, this might be the most crucial one. You have to ask yourself, can this company keep up its quality and its growth for the long haul? Not just for the next year, but for 5, 10, maybe even 20 years. That is the real test of a true compounder.
And finally, we have P for price. And this is all about discipline. Because look, you could find the best company in the entire world, but it can still be a terrible investment if you overpay. Getting in at a reasonable price is absolutely non-negotiable.
Okay, so let's zoom in on that price part for a minute, because this is where so many investors, even smart ones, can get tripped up. We're going to look at a couple of key metrics that really prove why this piece of the puzzle is so important.
To really get a feel for a company's quality, for its real ability to generate value, the legends like Warren Buffett, they look past the official profit numbers. They focus on something that's much, much harder to fake, pure, simple cash.
And that brings us to free cash flow. What is it? It's the actual cold, hard cash a company has left after it's paid for everything it needs to run and grow the business. This is the money that's free and clear to reward shareholders. Through dividends, stock buybacks, or just reinvesting for even more growth. It's the true economic engine of a business.
So, back to that price question. How do we figure out what's reasonable? Well, there's a really powerful tool called the PEG ratio. It's a super clever metric because it does more than just look at the price versus earnings. It connects the price to how fast those earnings are actually growing.
And here's the proof in the pudding. This is what's so cool. The study actually went back and analyzed companies based on their PEG ratio. And the pattern was crystal clear.
The companies with a PEG ratio of less than 1, basically their stock was cheap relative to their growth rate. They delivered the highest returns, and not by a little, by a really significant margin.
So let's put this all together. You've used the QGLP framework, you've found a great company, and you've bought it at a fair price. You've done all the hard work. But there's one final ingredient you have to add, and it's almost like magic. That ingredient is time. Lots of it.
This is where the real superstar of the show comes in. Compounding. It's the engine that takes a good investment strategy and makes it a life-changing one. But it demands patience, because its power isn't intuitive at all. It's completely exponential.
And that same study illustrates this just brilliantly. Let's imagine you're earning a fantastic 25% return every year. Now that's great. Your money grows nicely. But the real, mind-bending, how is this possible explosion in value? That only happens when you stretch that timeline out over decades. Just look at these numbers. Let's say you start with 1 rupee. In 10 years, it turns into about 9 rupees. Not bad. But wait another 10 years, so 20 years total, and it leaps to almost 87 rupees. Okay, now we're talking. But wait just one more decade, 30 years in total, and that one single rupee explodes into 808 rupees. Think about that. The last 10 years create way more wealth than the first 20 combined. That is the insane power of time.
So let's wrap this up with a final thought, a piece of wisdom from one of the absolute greatest to ever do it. It just ties everything we've talked about together perfectly.
Charlie Munger just hit the nail on the head, didn't he? He said the real secret isn't just understanding how powerful compounding is. It's also about having this deep appreciation for how incredibly hard it is to get it right, to find those rare companies, and then, maybe even more importantly, having the discipline to just hold on and let that magic work.
So here we are. India's multi-trillion-dollar future is happening right now. It's unfolding before our eyes. By focusing on those 4 things, quality, growth, longevity, and price, you literally have the blueprint to be a part of it. So the only question left to ask is, what are you going to build?